Board meeting for San Bernardino County, April 10th. It is 9 o'clock, it's not 9:03, but can we all rise and say the pledge led by Supervisor Mark Medina.
Salute. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, very good. Thank you. Can I have a motion for a certificate of posting?
So moved, Mr. Chair.
Second. All those in favor say aye.
Aye.
Opposed? Hearing none. We'll move right on to the regular agenda. CEO Espinosa.
Thank you, Mr. Chair. Yes, we do have a budget review day today. I want to thank Joe Paul Gonzalez, our auditor controller, today. He's prepared 3 agenda items, so we'll be discussing OPEB, where we stand, TEETR, as we have in years past, as well as provide your board a CAF report as a third item. And then we have Melinda Casillas that will be presenting items 4 and 5 today. So thank you, Joe Paul, for working on OPEB, and Joe Paul is here to present this item. Thank you, Mr. Chair.
Good morning, Chair, Board of Supervisors. Today, you're in for a delightful array of presentations. Thank you.
Always is better when people could hear you.
Yeah. Generally, yes. Today, we have 3 presentations to provide you. The first is the OPEB, or Other Post-Employment Obligations. This is the actuarial report dated as of July 1st, 2017. Okay, for most of the board, this is kind of old news. You know that the OPEB obligations started in actually 1993 with Resolution 9396 when the county joined the PEMCA Act, which offered employer retiree contributions, which started off as $1 per month to what the OPEB obligations are today are much different. So, retiree health program, as of the date of this valuation, in 1993, the county commitment created an obligation to provide a county contribution to each of its current day eligible 237 retirees and 432 active employees earning service eligibility for health care benefits. An employee is eligible for a county contribution towards medical coverage provided they retire from the county and from CalPERS, and typically on or after age 50, with 5 years of PERS service credit. Normal age of retirement, however, is 55 for the miscellaneous plan. So the 2018 contributions for active employees is the same as for retired. The single amount is $550 that the county pays as a health care contribution. The 2-party contribution is $1,050, and the family plan is $1,315. And again, there's no difference between active and retired. So we have the OPEB actuarially determined contribution. The purpose of this valuation is to measure the liability associated with this obligation and to determine an actuarially determined contribution for the next fiscal year, for this fiscal year and next. The ADC, which is easier to say, is a target contribution for the county's OPEB plan. And this is required under the GASB. The GASB, which is the Governmental Accounting Standards Board statements. I haven't presented this in the past to the board. This is for the board, it may be a new concept. There is under the GASB and under the actuarial standards, the actuary is required to kind of separate out this thing called the implied subsidy. And so effective 2017, the CalPERS, the county left CalPERS healthcare program that was provided through the PEMCA and joined the CSAC EIA healthcare plan. The CSAC EIA premium rates are the same for actives and retirees covered under the same medical plan. So that's a very important point there. The premium rates are the same for actives and retirees. Since non-Medicare eligible retirees are typically much older than active employees, their actual medical costs are typically higher than for actives. And so what that means is if you have retirees whose average age is older than the active employees, before they reach retirement, before they reach Medicare eligibility, they're actually incurring more cost, retirees are, and so than actives are, because actives are actually a lower age. There's an implied subsidy because the rates are the same. They shouldn't be. The rate should be higher for retirees than for actives because simple experience of the cost experience. And so again, the GASB and the actuarial standards require that this implied subsidy be measured for liability valuation. So as of July 1st, 2017, this implied subsidy, the actuarial liability of that is almost $6 million. Using the actuary uses a 7% discount rate. The present value of the projected county contributions, which is the actuarial liability, is over $33 million. In that $33 million is that almost $6 million in implied subsidy liability. So the $33.4 million represents the present value of all benefits projected to be paid by the county for current and future retirees. That's what the present value today. This is what it's expected to cost. If the county had this amount sitting in a fund earning interest at the rate of 7% per year, and all other assumptions were met, the fund would have enough to pay for all the county's required contributions for retiree health benefits. In theory, of course, based on this model. The OPEB liability, previously we would refer it under GASB 45. It was referred to as the actuarial accrued liability, AAL. Reflects the amount attributable to past service of current employees and retirees. In other words, that amount, those costs that were never recovered when retirees were working, we didn't recover that cost. And for current employees, that amount that we haven't captured yet as a benefit that they've earned and the cost associated with that benefit. For active employees, it's about $9 million, and you could see that over double the cost of retirees. Those were costs that were not recovered, about $19 million. So active employees and retirees together equal over $28 million in OPEB liability.
So I got to ask a question right here.
Sure.
I think a question that everybody has. You know, for the active employees, we've been contributing where we don't go backwards. Aren't we contributing enough where we're catching up on that number and beating that down, as well as with the retirees? Why would that be increasing?
This is just the liability. I haven't talked
right.
about the assets yet.
So there's more to come that
Yeah.
we're not at the bottom line.
No, this is not the bottom line yet. Because
Okay.
if the board had done nothing in pre-funding, this would be accurate.
Right.
In
but
other words,
we
you
have
have-
been doing something.
Yeah, you have
and
been
we
doing-
haven't got there yet. Okay.
That's right.
All right, that's good.
I know you're very excited about this presentation, but if you could contain your enthusiasm.
Yeah.
Okay, net OPEB liability. The net OPEB liability previously referred to as the actuarially accrued liability. I'm sorry, unfunded actuarially accrued liability. Again, it's $28 million. The actuarial value of the assets, we have $21 million as of 7/1/2017, sitting in the OPEB irrevocable trust. It's called the Siebert with CalPERS. So the difference is the unfunded net OPEB liability, almost $7 million. So the funded ratio at that time, at 7/1/2017, was 76%. So this $7 million amortized over 20 years is about $650,000 a year. So this is the amount of unfunded net OPEB liability that if you amortize it, this is how much we have to pay annually to cover that amount of that has not been recaptured in cost. So the ADC for 17-18, you see that 650 number there, the amortization of the net OPEB liability was $650,000. When you add the normal cost for the fiscal year end is $763,000, and so the ADC for 17-18 total is $1.4 million.
Okay. Supervisor Munzer has a question. Joe Paul?
Yes.
So, Joe Paul, jumping forward in your presentation, I don't see the, what is it, $4.5 million from the enterprise zone that in PARS. Is that going against this $6.8 million?
This is OPEB. That's pension.
That's pension. Okay, thank you.
Yeah.
All right.
In the following year, 18-19, it's slightly higher. The ADC is about, it's $1,438,409. So it's kind of, it's not quite apples to apples comparison, the annual required contribution and the ADC, but it's basically the required payment that we have to pay annually. You can see in 7-8, the first year that the county made a contribution of $2.4 million to get the fund started. And in 2012-13, it was over $3 million. By 14-15, it had reduced to 1.8. In 15-16, the ARC payment was 1.84, but we did not make that ARC payment.
Why?
It was not budgeted.
Mr. Chair, if I may.
Yes.
So when we discussed that year during our budget, we were confronted with operations and a lack of staffing, and we had a choice: two roads: either continue to do what we're doing, or put that on hold and address some of our infrastructure needs and some of the other really important things. So your board, along with us, we decided to hold off on that year and to deal with the operations side of things.
Okay. That's right.
But if you look at, and Joe Paul's probably going to explain this, if you look at it, for this year it's 1.4 million, and I believe it was 76%, I think, the prior page. So shows that we were still in pretty good shape, and addressing kind of the core operational issues that we needed to at that time.
So we have 3 years that, including this year, that we did not budget a contribution to the Siebert. In fact, in 16-17, we actually drew down $1.3 million in distributions from the Siebert to make our retiree payments for retiree health care. But one thing I will mention, in each of those years, the county was paying directly the cost of retiree health care. So we have always been making those payments, which is significant because PAYGO, as it's referred to, is increasing every year. And so, it looks bad, but it's not as bad as it looks because we have been making those PAYGO payments. So, the money that we have in the irrevocable trust, it's the Siebert, started with that initial contribution of $2.3 million. We added another $12.6 million. We took out $1.3 million in 16-17. The expenses through all these years since we've had the Siebert with CalPERS have only been $123,000. So we've actually had investment earnings of over $10 million. This report is as of December 31st. So it was actually a pretty darn good timing of creation of the irrevocable trust, and we were just really lucky that we invested when times were tough, and so it was not the bottom of the market, but it was pretty close, and so we were able to enjoy these investment earnings, significant earnings. It's actually pretty amazing that we could earn that that kind of money. We don't earn that kind of money in our county treasury. So my recommendation is that the board direct that for 18-19 budget that they try to include appropriations to cover the actuarially determined contribution. Remember, half of the contribution is coming out of the general fund, and the other half is coming out of subvented funds. And this is something. The next recommendation is something that the CEO and myself and the budget officer were discussing as to what what should be the OPEB policy concerning disbursements. We think that there should be some sort of trigger that should trigger those disbursements, that the board, through your policy that you adopt, those disbursements would be made. So we'll be coming back to you with that intended policy. We have we have a similar policy with the PARS retirement. Basically, it sits there in that account. There has to be certain conditions have to be present before we can draw on those funds to make retirement contributions.
Okay. Any questions from the board?
I have one.
Supervisor Bunser?
Joe Paul, I believe we've asked you before to see if you can find out what the other agencies throughout the state, and especially in our region, what percentage they're funded. Because my assessment dealing with other supervisors and city councilmen is that most agencies are not anywhere near 70%. Were you able to find out any information on what the other agencies percentage?
I at the Bay Area meeting of county auditors, I asked that question, and you're right. It's all over the board, but counties. Let's take, for example, Contra Costa County. They have, I believe it's, if my recollection serves me correct, it's close to $2 billion in the unfunded amounts for health care benefits. Enormous amount of money. Of course, they're a huge county. And they have pre-funded, and they're starting to pre-fund in the tens of millions of dollars. But that's a drop in the bucket for the amount of liability that they're creating there. But on the other hand, you have Monterey County, who's I believe they were 80% funded, is what the auditor I think explained. But their pension, their OPEB benefits are substantially less than ours. They have the PEMCA minimums in Monterey County, so it's an easier target. There are and I asked the question also of the Siebert representative that was in my office here, I think in early March. And of the agencies that have the irrevocable trust with the Siebert, this is not an unusual funding ratio of those agencies. So it's as far as other agencies, I really can't speak to that, because if they don't have an irrevocable trust with CalPERS, I just don't have that information.
Mr. Chair, if I may add.
Yes. Mr. Espinosa.
So, and absolutely right with regards to Joe Paul's comments. Santa Cruz, as an example, has a sliding scale. So they base it on years of employment. So however how many years there are, it goes out, and then the benefit then is a greater benefit up to about $300 or $400 benefit over the life. So if they work there for 30 years, they get, I think, a maximum of $384 or thereabouts for their medical, for their insurance. So it's a sliding scale. So it is all over the place. Every county, they kind of do it a little bit differently on how they provide OPEB or benefits, especially for retirees. With regards to this, though, I just wanted to highlight that it is a pretty rich benefit even today, even with caps. and I think your board has done a lot to fund it to where it's at today. I think that needs at the overall picture. You need to look at that. It's a pretty good benefit, and it's the cost for some of the employees years ago. Were never really, maybe I wouldn't say heated entirely, but as time went, about 7, 8 years ago or thereabouts, we started really addressing that and covering the cost. So the current employees are covering a lot of cost for the retirees. So I just wanted to make sure that the board is aware of that, and this report shows that there was a lot of progress. So thank you, Mr. Chair.
Thank you. Any other questions from the board? I know, as we put together the budget, it's all one, this is just one piece of it, and as the weeks go by here, we'll see how it fits with the recommendation, with the overall budget, and how we keep moving forward. But I appreciate that presentation. Is there any comments or questions from the public? If seeing none, we'll move on to the next item. You're still at bat, Mr. Gonzalez, so let her rip. Talk about the teeter fund allocation and what that's all about.
Okay. So I was gonna I was prepared to skip slides today, but I had a request from my staff, new staff who are not familiar with the teeter fund, to kind of explain it from cradle to grave on this presentation. I beg the board's indulgence. So, what's the teeter plan? This is in the 1940s. The auditor controller from Contra Costa County, Desmond Teeter, proposed an alternate method of tax apportionment. This alternate method allows counties to allocate secured utility assessments and or supplemental property taxes to property tax revenues receiving jurisdictions such as counties, cities, special districts, and schools at 100% of the billed amount rather than actual collections. Legislation was enacted and the revenue and taxation codes govern the teeter plan administration. So what this means is the schools never have to worry about getting their full property tax allocation. Neither do the special districts, and neither does the county or cities. Because the teeter plan, which is administered in the Auditor Controller's office, buys all the delinquent receivables from unpaid taxes. And in return for buying those unpaid taxes, the county receives penalties and interest when those taxes are finally paid, and that teeter fund revenue stays in that fund until the board says, well, we can use that revenue for different purposes, and we use it annually. So the benefits of the teeter plan, they're threefold. The property tax estimation and allocation process is simplified. The jurisdictions have more stable and reliable annual property tax revenues. And for the county, the teeter plan is a revenue generator for the county. One of the pitfalls of the teeter is that they can have very huge cash requirements needed to purchase delinquent taxes. In 2009, Tulare County terminated their teeter plan because the county just did not have enough cash to sustain the program. So Tulare lost this, this program, and they, basically, the schools are not receiving the budgeted amount. They're receiving the actual amounts of actual collections. So this is actually in Tulare County, that could be very painful for the schools, not knowing exactly how much they were going to receive. So how's the county's teeter plan performed in secured property tax and special assessment buyouts? We're going to talk about the cash flow requirements and the teeter delinquency revenue earnings. Let me see. Excuse me, I think I need to. Okay, in this slide is starting from 2008-9 to current year. You could see that the total beginning prior secured unpaid taxes in 2008-9, we already had over $8 million in prior secured taxes. That year we had to buy another over $6 million. So altogether, over $14 million in unpaid taxes. You can see that every year that amount has the amount of buyouts has decreased, and the beginning balances of prior secured has also decreased. The blue line. To current day, we have around $2 million, a little bit over like $2.2 million in prior secured unpaid taxes. We begin the year that way, and we buy approximately $1 million, slightly over $1 million in new delinquencies. Here's a kind of a 5-year look at those same curves. You can see that the curves are not as steep. So we're actually leveling off as far as the new buyouts and the prior secured unpaid taxes as well. The yellow line there is a cumulative revenue. We've made over $9.3 million in revenue from the teeter fund. So it's not as good as the OPEB earnings, but over this number of years, it's still a pretty good revenue generator for the county. The penalty revenue is expected to be lower this year than even the prior year. So this year we're expected to bring in about $590,000 in revenue that could be distributed to the general fund. We budgeted $600,000. So we're close. We're close as far as that estimate.
I'm kind of surprised to see that that's dropped off a little bit, being that the other unpaid tax lines are kind of holding pretty steady. I would think that the penalties would have to be steady as well.
It's interesting. It's an interesting. It's interesting to me as well. In speaking to one of my staff members this morning, what is it? The only thing that I can surmise is that some of those delinquencies that we're holding are becoming stale, and so the new stuff is coming in and being cleaned up quicker, but some of that stuff is just staying stagnant. Those delinquencies are staying stagnant in the fund. But that's just my guess right now. But I'm going to look into that.
Mm-hmm. Thank you.
So this is what beginning cash balances look like in each of those years. You can see we had negative money in 2008-9 over $2 million, and again in 9-10 we had about $800,000 in negative cash to start off with. But by this year, 17-18, we have begin the year out with about $3 million, over $3 million of cash balances. When you look at the cash that's paid within the year and then unpaid at the year end, the teeter cash requirements are really the sum of both is really about $2.2 million. In 17-18, the secured property tax special assessment buyout is estimated at about $1.1 million. Our teeter loss reserve fund is calculated at about $300,000. And assuming that the economy continues to improve, excess teeter cash can be declared for general fund revenue. As I mentioned, $590,000 is revenue generated for 17-18. This is our expected amount. And as hopefully the economy improves. As the economy improves, we will have opportunities to utilize the revenue from the teeter fund to utilize in the county. And again, the board may wish to transfer one-time excess amounts of revenue. Some counties operate the teeter fund, basically taking all of its revenue, and the teeter fund has to go out and actually look at issuing tax anticipation notes, so that in other words, the county is the teeter fund has to go find its own financing. Currently, the teeter fund uses all the county's funds that are in cash that's in the county's accounts to basically fund the operation.
Okay.
So, Mr. Chair, if I may add one more comment to that.
Yes,
Mr.
CEO.
So, last year in our policies, we looked at this as revenue for the county. So we allocated funds into our budgeting for that. Again, this year we're going to request the same thing with our policies. I believe it was $600,000 is what we allocated last year, and we're going to request the same thing this year. Just want to let the board know.
Very good.
Thanks, Mr.
Any questions from the board? Any questions or comments from the public?
Good morning, Marty Richmond from Hollister. Looking at the TITA plan maximum minimum cash requirements, it looks like the unpaid year-end I-roll is becoming a much bigger percentage of the entire fund than it was earlier. That's what it appears just from the chart. That percentage-wise is much bigger. So I agree with Joe Paul Gonzalez that I think you've got some property in there that is becoming stale and people are never going to pay. They are never going to pay that. And basically that means that's a bad debt. You either foreclose on it and sell it for whatever it's worth and take the difference, or something. But I think at some point in time, if people have not paid their taxes when times have been good, and they have been good, they're certainly not going to pay them when times are bad, and they will get bad. So you've got some bad debt in there hiding. That's what I call stale. That's my term for stale collections. And I think you ought to get a evaluation of that bad debt and offset it, even if you don't want to identify individual properties. I think you ought to have between the assessor and the auditor get an estimate of what you think is the bad debt, and get that mentally off your roll, so we don't start spending money against bad debt that we're never going to be able to collect. That's one thing. The other thing is, since this is a high return if things go bad, if things do go bad, the cash you have access to in the OPEB funds is cash you could use to buy teeter debt when you know it's against good property. When you know the property value has got the debt covered, then you're not worried about getting stuck, because you can always foreclose, I know it's a pain, and sell it out. Thank you for your time.
Thank you. Anyone else? That, I'll close public comment and, bring it back to the board for comment, or maybe Mr. Gonzalez has a comment. But, yeah, I'm kind of concerned about that penalty revenue falling off like it is. And, at some point, I'm not sure which department takes action on unpaid taxes, but I pay my taxes and everybody else pays theirs. And after a while,
it's a. I think the comment that Marty just made is absolutely correct. I think we need to do a kind of analysis of aging of these delinquencies, and start using that tax loss reserve fund to buy those out.
Yeah, whatever is the appropriate action, I think that should be just records that are kept. It wouldn't take a special study or.
No. This is just the existing receivables that are in the fund, that the fund has purchased. We need to do a analysis to an aging of those receivables.
Right. Any other comments?
Just, Mr. Chair, from the private business. We're in the process of making some big ticket item purchases, and one of the requirements is that we got to provide an aging both on the AR and the APs. And I got a first rejection return because some of our ARs showed beyond 120 days, and the chance of collecting on 120 days very, very slim. So I had to take them out, and so now I'm fighting for a lower interest rate. And so I agree with Marty what he said. I think we need to revisit and see what the agents are on all those accounts, and start looking at a more true picture for future years. Thank you, Mr. Chair.
Thanks. All right, thank you. We'll move on to your third item, Joe Paul. Comprehensive Annual Financial Report. CAFR.
As soon as I locate it. Okay. There's a few slides that I added to the existing presentation that's in your packet, and I just thought this is really the first time that we've actually presented the CAFR to the board at a public forum. Generally, we simply distribute the hard copies or electronic copies of the CAFR to the board. So wanted to do a little bit more without getting too far into the weeds, because the CAFR is really a highly technical document. It's even drier than the Teeter Fund. Okay, so in the CAFR is a letter of transmittal that I write to the board, and it's simply that we're pleased to present this CAFR, and that it's intended to present information above and beyond what is required by generally accepted accounting principles or state law. And this report contains management's representations and is prepared by the Office of the County Auditor. Consequently, management assumes full responsibility for the completeness and reliability of the information contained in this report, based upon a comprehensive internal control framework that is established for this purpose. So, as part of the process of preparing the CAFR, and once it's completed, both your CAO, Ray Espinoza, and myself, we sign a management representation letter where we are basically putting our signature. We're attesting to that everything that we have presented in the CAFR is, we believe, to be true and correct. So the independent audit of the financial statements of the county include a broader federally mandated single audit. I believe that was passed out this morning by Janet. There's a copy in the back. It's designed to meet the special needs of federal grantor agencies. The standards governing single audit engagements require the independent auditor to report not only on the fair presentation of the financial statements, but also on the audited government's internal controls and compliance with legal requirements, with special emphasis on internal controls and legal requirements involving the administration of federal awards. These reports are available on the county's website and are separate from the CAFR. So management is required by Government Accounting Standards Board to provide a narrative introduction, overview and analysis to accompany the basic financial statements in the form of the management discussion and analysis. We call it the MD&A, in conjunction with financial statement reporting. This letter of transmittal is designed to complement the MD&A and should be read in conjunction with it. So the CAFR is organized. There's an introductory section that's intended to familiarize the reader with the organizational structure of the county, the nature and scope of the services it provides, and the specifics of its legal operating environment. The financial section includes the independent auditor's report on the basic financial statements, the MD&A, the audited basic financial statements, note disclosures and supporting statements, and schedules that are necessary to provide readers with a comprehensive understanding of the county's financial activities of the past fiscal year. This is vitally important to the county as it relates to its efforts to try to procure any sort of loans or any sort of financing. The third section is the statistical section that provides the reader with additional historic perspective, content, and detail to assist in using the information in the financial statements. It provides information in 5 categories: financial trends, revenue capacity, debt capacity, demographic and economic information, and operating indicators. So on your page 32 is the table of contents. You see the introductory section there and the financial section and all of the where the statements are and the RSI. The second page of the table of contents is the statistical section, shows those on page 33. So right out of the MD&A, I wanted to talk a little bit about the actual performance of the county for June 30th, 2017. Tax revenue, as you can see from fiscal year 17 over 16, increased by $1.6 million. And so that's a 9.6% increase for the county. That's directly related to our residential development. The aid from other governments actually decreased by 2.6%. That's kind of an interesting one because there was actually in the hundreds of thousands of dollars that was found by the external auditor to be just outside of the 60-day requirement. So we could not include it in 16-17. And so it will, it'll be reflected in the current year.
So, Joe,
yes.
so that'll be, you'll have two periods to correct the understatement and overstatement.
No, what you're seeing here is everything that's being presented here has already been audited and is corrected.
Okay.
Expenditures by function, you could see there that in public protection, we had a significant increase, a 7.6% increase over last year. That was due to $2.1 million over the previous fiscal year. Approximately $1 million was due to expenditures resulting from the disaster recovery costs associated with the flooding disaster of the February 2017.
Mr. Chair.
Yeah, go ahead.
Ray, can you get any update on getting reimbursed for those expenditures?
Yeah, I'll invite him up.
No? Not good.
The information that we have on the reimbursement for the disaster expenditures is that they've been submitted to OES and FEMA, and they have been, most of them have been approved, and so we're expecting reimbursements to begin in the next couple of months. I don't know that they're going to necessarily hit the 17-18 budget, but if not, they should, actuals, they should be in the 18-19. As you know, with disasters, FEMA and OES, it often takes over years in order to collect all the reimbursements that were due. So yes, the process has started, and we're expecting some actual reimbursements to be coming our way pretty soon.
Okay, thank you, Melinda. One more question, Mr. Chair. It's going to be 100% of the expenditures, or it's going to be some type of discount?
You know, I'm not positive on what our reimbursement rate is. Do you have any information? I've been talking to Kevin off and on, trying to get some information as to how much we're going to get reimbursed on those disasters. I think there's a couple things that we haven't actually completed yet that are still on the list to complete before we could get reimbursement for them.
Okay, perfect. Thank you.
Yeah, I know we have quite a couple of roads that need reimbursement, and just talking with other counties, when I go up to RCRC, there's a real high level of frustration with FEMA, with other counties trying to get their reimbursement, and they're having troubles too. Talk about the devil. But walk in and you get in trouble, Kevin. Congratulations on your new addition to your family, though, by the way. And,
thank you.
We're all thrilled for you.
Yeah, she's great. So I didn't hear all of it because I was running over here, but I watched some of it on the live stream.
Yeah,
but
the question is from Supervisor De La Cruz as far as the status of the reimbursement for the emergency expenditures that we had during the disaster of last year.
Yeah, so actually some of the checks have started to roll in already. It's obviously reimbursement based, so we won't get a lot of the money for the big projects like the historical park or Lover's Lane until after that work's completed. But we haven't deposited some of the checks we got, and we're talking last week, 2 weeks ago, because there was a little hiccup that Joe Paul's been working with me on, where somehow FEMA got the idea that we had an insurance policy that covered debris removal, which was not accurate. So they essentially took a project that was $300,000-$400,000 and knocked it down to about $1,700. So we're working through that, but we didn't want to deposit any of these checks just in case they're saying they're going to issue a new check, and they need to cancel the one they already sent. And but once we get that worked through, we'll make sure to get those in to the auditor's office as soon as possible. I did hear one question about percentage, I think. So it is not, there is a cost share. So the federal government in this case pays 75% of the cost of the disaster, and then the state picks up, I think I'm getting that number wrong, the state picks up another 75%. So basically we pay, I think what it amounts to is about 8% of the total costs, which in many cases for many of these projects we end up making back anyways because of in-kind matches or due to personnel time or whatnot, which can go towards that share of ours, the share that we have to pay. So it does get pretty close to 100%.
Thank you, Mr. Chair.
Okay, good. Any other questions from the board? Thank you, Mr. O'Neill.
No problem.
Okay, continuing with the presentation, talk a little bit about the general fund. So the general fund, of course, is the chief operating fund of the county, and all activities not included in a separate fund are always included in the general fund. As of June 30th, 17, the unassigned fund balance totaled $15.6 million, while the total fund balance totaled $28.9 million for the general fund. General fund expenditures increased by 5%, $1.6 million, mainly due to the flooding, as I previously mentioned. Emergency evacuation, let's see. Revenues increased mainly due to an increase in tax revenue, $1.5 million growth in housing development contributed to the property tax revenues increase.
Hey, Mr. Chair.
Oh,
Joe or Ray, these tax sharing agreements we have in place, with the annexation agreements that we have in place, where that revenue gets hit?
Mr. Chair, if I may, to add to
Yes,
that.
go
So,
ahead.
as I was going to actually comment on that right now. So, as the board's aware, we actually received approximately $4 million for the tax sharing agreement with the city, with the building going on in the city, with Benchmark and Award. Obviously, we're going through litigation right now, and there's an appeal process. But the funds are not represented here. I want to make sure that you're aware of that. They're not represented here. This was for last year, as well as a separate fund for now. One other thing I want to mention is we also received approximately $2.5 million for PV2. That's also not here as well. So I just wanted to make sure the board's aware of it. So probably represented the following year.
The following year, okay. And once we do record it, what item would it go under? Property tax?
What do you mean? It would probably be, are you referring to like general fund?
Yeah, right.
It would be in reserves most likely, and we'll discuss it at the
Okay.
next budget time, just like we do with all
Okay. Got it.
funds.
Thank
Yeah.
you, Ray.
Yeah.
It'll be brought in as a general purpose revenue because it's not a restricted revenue, and then it'll fall into fund balance. You can't read this, this statement here. This is a comparative statement from 14-15, 3 years to 16-17. The only purpose I brought this forward is to show the growth in the last line, the fund balance. In 14-15, we had $21 million in fund balance, and 15-16, $27 million, and in 16-17, $29 million in fund balance. Here, this is just an illustration that shows how the fund balance has grown, and also how we segregate the fund balance under GASB 54. That is assigned, unassigned, committed, restricted, and non-spendable. In the 16-17 single audit, there were 5 financial statement findings and 1 compliance finding. These were findings that when we presented the final draft of the CAFR and the single audit to the external auditors, and the external auditors are actually here. Today we actually have Alba Zuniga sitting in the back. She is a partner with CLA, and so my intentions to embellish how good things were going went out the window there. So these findings were there were findings that were dealt with in the final audited version of the CAFR. So any misstatements were corrected in the audited final version of the CAFR. And but there are recommendations that were made, and we plan on following those recommendations. So I'm not really going to cover each one of those findings. I'm going to talk about the external auditor, the 4 types of audit reports that the external auditor can issue. One is an unqualified opinion, and an unqualified opinion indicates that the information presented in the company's, in this case county's, financial report is clean. A qualified opinion could be a limitation in scope. Not all the information was available for the auditor to audit. There could be a disclaimer in opinion where they just don't have an opinion on the financial statements. Or an adverse opinion would be, obviously, these are obviously the statements are wrong. They cannot be relied upon. And however, in the opinion and the report issued by the independent auditor that was directed to the members of the board and really to the grand jury, and the statement reads, in our opinion, based on our audit and the reports of other auditors, the financial statements referred to above present fairly in all material respects the respective financial position of the governmental activities and business type activities, each major fund, and the aggregate remaining fund information of the county as of June 30th, 2017, and the respective changes in financial position and, where applicable, cash flows thereof for the year then ended in accordance with accounting principles generally accepted in the United States of America. So this is Clifton Larson Allen, LLP, as of March 28th, 2018. This is the definition of a clean opinion. I just wanted to give you a little kind of a update of where we've been as far as the CAFR preparation. In 13-14, we submitted the final draft of the CAFR to the external auditor 25 days before the March 31st deadline to the Federal Audit Clearinghouse. Not too good. It was submitted March 6, 2015. The following year did a little bit better. 14-15 CAFR was submitted February 29th, 31 days before the March 31st deadline. 15-16, a significant increase. We actually did 67 days before the March 31st deadline. It was submitted on January 23rd, 2017. This year, it was submitted December 20th, 2017. That's 101 days before the March 31st deadline.
And that's
Mr. Chairman.
significant. I think, yeah, go ahead, CAO.
And just for clarity, so it was submitted to our outside auditors for review on these
For audit.
For audit.
Yeah.
I just want to make sure the board was aware of that.
Yeah, and-
Not submitted to the Public Clearinghouse. It was submitted so that way we can get the work done so we can submit it.
That's right. And, I think there was a real huge improvement in the departments getting their work done and submitting it to your office and work of the audit committee, which Supervisor De La Cruz and Munzer is a part of, and kind of keeping that moving forward, and really appreciate that work. It's a whole lot better to do your homework way ahead of time rather than at the last minute.
Well, it's true that in past years, the issue has been that we have not been able to get information timely from departments. This year, we actually assigned auditor accountants to actually go to the departments if the work wasn't done, to get it done, to ensure that the auditor's office had it for presentation in the CAFR. And so next year, which I really hesitate to push this button because this, it's an estimate of where we want to be next year.
November.
Next year, we'd like to submit no later than November 21st, which is 144 days before the March 31st deadline. This might not be good enough for. We might miss it by a couple of weeks to be able to have the CAFR submitted and audited and issued by the external auditor by December 31st. but it will be significantly better than this year, or certainly from any prior year.
Supervisor Medina?
A great job on the decreasing the amount, or the time, I should say. My question here is, what's the norm? I mean, I know we don't want to. You're looking at November 21st of 2018 for this year, but what's everyone else? Where's everyone else at? And we don't want to be too fast because you might miss certain things, or certain things that happen when we're too fast on certain things. That's what I'm just trying to figure out.
Well, I think the standard is that you want to get done by early November.
Okay.
So that the auditors have plenty of time to conduct their audit, and so that our internal deadline is December 31st. Remember, for all other purposes, the March 31st deadline is timely. And so we have been timely with submission of the CAFR. My issue is that I would like to bring it to you sooner because, the information is more timely to you, and that you could use it. It's more relevant. The information is more relevant. That's why we really want to get done and have the audit completed no later than December 31st.
So November 1st would be the earliest we can ever do it.
I'm sorry.
November 1st would be the earliest we can ever send it to the auditors.
Actually, there's counties that do it significantly earlier. There are counties, but we're a small county. We have limited resources. We're not a rich county, so
Okay.
we have to be kind of practical about what our expectations should be.
Yeah, I think the CAO has something to add to that, too.
Yeah, I just wanted to add that, if you recall years past, we really didn't have a good financial system that was actually up to date with items. And what has transpired in years past is we would have to go physically, manually go look at paperwork and grab that and actually utilize that within the report. And one of the aspects that we looked at is having a more robust system that's entered as we work, and it's more readily available and more up to date, where we don't have to go back as much. And so if you need to pull the data, you can pull the data immediately at that point for this. So that was kind of one of the really a large undertaking by staff, by the county, and by your board to invest in the ERP system. The whole process, the budget piece of it, integrating our ongoing daily activities in the system, just makes things more timely or more quicker to report out and look at data and look at information. So this is kind of one of the fruits of all that hard work. Thank you, Mr. Chair.
Yeah, that was really what I, as one supervisor, I was hoping we'd get out of that ERP system, and everybody's starting to get that integrated, and we knew it was probably take a couple of years, 2 or 3 years. Maybe we're not completely integrated yet.
Yeah, we're not completely. We're still working on it. It's still a work in progress, especially in RMA. There's still some more integration we need to use with CAMs and into the system, but we're definitely working on that.
That's true. It took a full year, actually over a year, to actually install the system and get it operating. Making sure that the balances came over correct, validated balances, that kind of thing. And remember, we also installed the HR payroll system immediately after the financial system. So it was a huge endeavor. And then during this period as well, we switched banks. We went from B of A to Wells Fargo. That was a monumental task because these interfaces that had been built for the Wells Fargo, for the B of A, had to be rebuilt for Wells Fargo, and even now, we don't have the desired interfaces that we want, especially like in Health and Human Services. So that's still a work in progress. So there was a lot of things that were going on during this period that contributed to delaying getting the CAFR out timely.
Mr. Chair, Terry Munzers and myself serving on the audit committee, we had a lot of healthy discussions the last, 3 or 4 years, Joe? Because, I mean, for anyone, even in the county department, March 31st is the most important day.
That's right.
Because if you pass that day, you're not eligible for grants, CPG grant, federal, and the list just goes on. And I know that Supervisor Jerry and I, we emphasize that a lot at the audit committee, is let's work for next year. These are the things we did this year. Let's work how to improve for the next year. And I got to commend some of the staff members who are here. Thank you for, going through those tough times. But we got those dates that we got to worry about, and it's about being a team.
In fact, Supervisor De La Cruz, at this time, I really wanted to introduce my staff members who have made, put in a monumental effort at getting this CAFR done. Leanne Godinez, Leanne, if you could stand up. She's the interim assistant auditor, and she's played the leading role in getting this CAFR out. Stuart Patry, he is a auditor accountant. I'm not sure if you were born in Hollister or.
No, Los Gatos, but I lived here, went to high school here.
Oh, great.
So Stuart actually lives in Morgan Hill now, so he does a reverse commute, but he's sort of like the character in The Godfather. Every time he tries to get out, we just pull him back in. That's what San Benito County's done for Stuart. And we have Kelsey McIsaac, if she can stand up. She's auditor accountant in the office that specializes in property taxes, and she's done a tremendous job at helping out. Ensuring that the CAFR is timely. In addition, the staff, the rest of the staff in the office have been a tremendous help in relieving us of some of the duties that we need to put aside when the CAFR appropriation starts.
Great. Thank you very much. Appreciate it.
So that concludes my presentation. I don't know if our external auditor would like to make any comments or is here for any questions that you might have. That's really it.
Would you like to come up and say a few words, ma'am?
Is she on the clock right now?
Good call, Jaime. I knew I liked you. You're done.
Good morning, Mr. Chairman. My name is Elba Zuniga, as Joe Paul indicated. I'm a principal with CLA, and the items that I wanted to cover are just a brief governance communication, which is referred to as the required communication that goes along with the completion of the audit. And we covered just some of the responsibilities, what the auditor's responsibilities are versus the management of the county. And the accounting policies that are reflected in the county's CAFR are typically located in Note 1, and that is like the framework for the creation of the financial statements. There are various accounting estimates that are involved in the preparation of the financial statements, and those are a couple of items that have been covered by Joe Paul. One of the items is the claims liability. We rely on outside parties to let us know what amount that we should be reporting in the financial statements. So our responsibility is to ensure that the amounts that are reported by the third parties are those amounts that are reported on the financial statements. Post-employment benefits, obviously that's a large liability. That is also, we rely on the third party to estimate what that amount is, to provide us the calculation of it, and then our responsibility is to see that the assumptions that are used there are properly reflected on the financial statements and the amounts actually match as well. And the third one is the pension liability, the large ones. The disclosures, we noticed that the disclosures in the financial statements are clear, they're neutral and consistent. we're required to indicate whether or not we had any difficulties encountered in performing the audit. And what we call, typically, we might say that there's a difficulty if we had a difficulty with management relating to disagreements or so forth. There were no disagreements. It was just a timely, the completion of the audit was a little bit delayed. We would have hoped to have all of the closing adjustments ready for us to audit. If that were the case, we could probably move up the delivery of the report, I would guess maybe 2 to 3 weeks. And I think that's the plan, is to come up with a plan that would meet that goal next year. Uncorrected misstatements, we did not have any, so any adjustments that we proposed to the county were properly reflected in the financial statements. And again, as I mentioned before, no disagreements with the methodology that would be used to report any of the balances. There was an audit of the group financial statements. If you'll notice on the CAFR, there's the primary government, which is the governmental activities and the business type activities. And there's a third column on the CAFR that refers to the San Benito, First Five San Benito, the commission. That report was audited by a different auditor, and that report did include a qualification for the post-employment benefits and the pension liabilities. And that, I just wanted to bring that up to you, because if your intent is to submit a CAFR to the GFOA for consideration in the excellence in financial reporting, that would preclude the county from being able to
Supervisor Munzer?
I think this is for Ray. Didn't we? I thought we cut ties with First Five. I thought they are totally on their own.
Yeah, we did.
So why are they ending up in our CAFR?
I don't know.
Although they are legally separate, and maybe they don't have the financial records of the county, because of the activities that they perform, they benefit the residents of San Benito County and other considerations. Right now, I don't exactly recall if you are part of the board that it also sits with them. Do you have representatives on their board?
I think we separated completely. No. Oh, wait a second.
No,
maybe
I think there might be.
Supervisor Medina is on that board.
Yeah.
We received the tobacco money from county as a revenue for the First Five.
Right. I know that at the beginning of the audit, Leanne and myself went through this big long checklist to see if they still met the criteria for being considered reported in your financial statements. Not to say that they're part of the county, but to say that they have such an affiliation and such a, we don't want the statements to be misstated to reflect otherwise. So they are presented in a separate column. And we make that perfectly clear that they're not part of the county, but that they have such a strong relationship with the county.
But they can adversely affect our CAFA.
They can. They can.
So do we need to look into some kind of reporting from them? Because I thought we were completely separate, and it sounds like we're not. So,
Mr. Chair, I made the argument. In fact, I was a lone vote on. I remember the discussion that came back to the board. And I lobby my fellow board members, do not disassociate us from that group, because some way or another we're still liable, and some way or another we're still going to be jeopardized or compromised in some financial way. And sure enough, here's the opportunity. And I don't know if we need to bring this back or not, but I express my deep opposition not to go in that direction.
Well, say less.
If it's all right with the board, I'd like to request that we can look at this a little further and bring this item back to your board.
Yeah, I think it needs to, because that was my recollection as well. But and that's fine. It's if they're affect our audit and there's no getting around that, then we ought to be part of the organization. Yeah, directly. Supervisor Medina, you have anything to add, or?
Well, we are part of the organization. I sit on the board.
Yeah. Well,
Margie sat on it prior to me.
then we'll hold you responsible for our audit.
Fine by me.
Okay, very good. Thank you.
Mr. Chairman, if I may interject, the county has the information that they would need. I believe it's just a matter of communicating, to making sure that with Joe Paul's assistance and Leanne's assistance, that they could gather that information so they could provide it to the first 5 for integration into their financial statements.
Okay, very good.
But, Mr. Chair, I'm talking more from long-term planning, because if we do decide to go out and get bonding or GMOs or some type of other financial vehicles in our audits, and we have very little oversight of our first 5, then that could jeopardize, potential for getting higher interest rate that we're trying so hard, all the other departments, to contain that risk. And then if there won't be any oversight, then what's the purpose then?
Yeah,
Mr. Chair, if I may.
CEO,
And I think what Supervisor Munzers and I probably a few of your board members are concerned with is that we sit on AMBAG, that they have their own Monterey Bay Community Power as well. We're represented there, but they have their own entity, so to speak. So I think we need to look at that a little bit further in regards to our support with some of these outside agencies and the risk that we have internally with that. Thanks, Mr. Chair.
Okay, thank you. Thank you very much.
Thank you.
Any other questions by the board? Any questions or comments from the public? Seeing none, thank you for the 3 reports, Joe Paul. Very enlightening.
Thank you.
And not as painful as advertised. We'll move on to item number 4, CEO.
Thank you, Mr. Chair. Yes, I have Melinda Casillas. She's our budget officer. She'll be presenting the next 2 items. The first one, as I mentioned earlier, was policies, so we'll discuss that. We'll review what we've had last year and the edits we have for this year, as well as an overview of our budget, kind of where we're at. We're still not quite done yet receiving budgets from the departments, but we're getting close, and then we'll just give you a highlight of that today. Thanks, Mr. Chair. Melinda?
Yes, good morning.
Okay.
Okay. So I believe at our last special board meeting, we talked about the fact that we were going to be bringing the policies before your board, that we were working on making a couple of changes to them. And so I believe in your packet, I gave you last year's policies. And then these are the updated policies for this year. Everything in red shows a difference from last year to this year. And I tried to also highlight if there was something new, if we updated something, or if it was the same policy. So we divided the policies into different sections. The first one, a new section, is operating policies. And as you can see, the first one, maximize opportunities to consolidate, collaborate, and cooperate with other agencies. That's the same as we had last year. Identify opportunities to provide service delivery. That's also the same. We updated and clarified. We updated the day direct departments to maintain the currently authorized fiscal year 17-18 FTEs. We're not looking at doing any kind of layoffs this year. And the CAO's office provides salary projections that include step increases, employer-paid benefits, and added this one, any known salary rate increases due to MOU agreements.
The only thing I see right there, should that, I know we're trying to make a concerted effort for some reclassification. Should that be identified in that as well? If you're stating step increases, employer paid benefits, and reclassifications in those departments?
We can add them
Yes,
in.
we definitely, yeah.
Yeah, and I could add them. And when we get to the human resources policies, I'll make sure that we add that in the final version.
Okay.
We just updated the date, consider increases to fiscal year 17-18 authorized FTE levels with the newer increased non-general fund. And there needs to be a revenue offset in order to increase on FTE. That we have the same increased transparency of true cost of government by including cost plan charges. Analyze the impact to the general fund's ongoing OPEB costs and evaluate the new actuarial study. This year it's called, I believe, the ADC instead of the ARC. So per Joe Paul's reports that he gave you, we are including retirement health, OPEB, and liability in our projections, in our initial projections for the 18-19 year budget. We have the same again, continue to identify areas for evaluation efforts by staff, committees and consultants to judge the effectiveness or efficiency of county services. Again, based upon the Teeter presentation, utilize the Teeter fund excess cash as a means for general purpose revenues in the general fund. And again, maximize the use of trust and special revenues, such as grants, to support programs and services that would otherwise consume general fund resources. Then we also split out some of our policies under human resources and personnel policies. We work to update and clarify. I'm sorry, that should say clarify. Our vacancy policy, vacancy budgeting policy, we felt that we needed to continue to clarify the purpose of that policy. It doesn't hinder departments from hiring if there was a vacancy. We just offset the savings. We recognize the savings as the year goes by instead of recognizing it at the end of the year when there's excess revenue over expenditures due to vacancies. Then we, the same as we updated a little bit, the changes to current authorized positions will not be approved until Human Resources has reviewed the impacts and also met with any bargaining units that require the meet and confer process. This is a new one. We are working with departments to create succession planning. And then we updated a word, department heads, they need to inform the CAO of impending retirements so that we're able to budget for that accordingly. Then we have a new heading, capital improvement policies. Basically the same thing as to prioritize the technology department. I'm sorry.
Can you hold on a minute? Maybe this is for you and Ray. Under new, work with departments to create succession planning. Is that it? I'll just say it blunt. I guess to you, Ray. Is that just putting words together, or do you really have a plan that you're going to roll out?
Well, with the budget itself, the budget is a document. It's a moving target. So we ultimately try to adhere to that and try to address that. This particular case, we have implemented some succession planning tools in years past. One of them would be a K-box as an example for white papers and incorporating duties and responsibilities of individuals within their office to import those so that way when new employees come on board, they can at least read that. So that's just an item or something that we've already started the process of. I think it's more important that there's a lot to this, and I think it's not just one piece. There's quite a bit. So we've been tackling that. To answer your question, we've started that. I think we just need to continue with it and elaborate further on it. So the answer would be yes.
Yeah, because that does have merits. If we really do want to hire within and promote within, I think that's a good idea, good concept. And I just want to make sure you're not adding words to this policy and then we don't do anything, and we'll say, okay, we'll revisit again next year and next year and next year.
Well, and if I may, Mr. Chair, the last year's CIO remarks for the budget, we highlighted addressing salaries. That was our primary goal for last year, if your board recalls. In that document that I wrote, we also discussed for this year to address staff classifications. And this year is that's going to be our main, really our kind of our main goal this year is to address classifications. The classifications, there's a lot of work that needs to be addressed there, and there's a lot of issues. With that also is succession planning. So those two items I think are going to be really key for this next year. And it's not just 1 year. I want to make sure the board understands this is going to be a multi-year mission and really try to accomplish it, because there's a lot to it, and we have very little staff in the county, so we have to look at it strategically and try to tackle pieces throughout the year.
Perfect.
And next year. Thanks.
Thank you, Melinda.
Okay. So capital improvement policies are basically the same as last year. We want to continue to focus on information technology, and then again, an update to adopt a capital reserve policy to address infrastructure and capital expenditures, and try to identify one-time revenues as opportunities to increase that reserve. Basically, reserves and contingency policies, we updated that to say create a general purpose reserve fund of 25 to 50% of general fund budget expenditures, excluding one-time expenditures. And this will be adjusted each fiscal year as needed, and create a contingency plan with the recommended budget to address unforeseen expenses or revenue reversals each year. And then, again, update, retain the rainy day reserves of $3 million on deposit. We had that we were going to make that deposit, so I changed that to say it's already been done. It's on deposit with PARs. And then, again, adopt a disaster recovery reserve of about $1 million. As we saw with the floods, it's important to try to keep that disaster recovery reserve in place. Any questions, any comments, anything that you wish to see in the policies? This is helping us draft our budget for this year.
From the board? Melinda, I do like the breakdown of the sections. I think it adds clarity. I like that format a lot. So That's my opinion of it. Any questions, comments from the public? Mr. Richmond?
Thank you.
Marty Richard from Hollister. I have on my own been doing a comprehensive analysis of the staffing of the county, and it's really bad. We're not. First of all, I did a head-to-head analysis with our competing counties. We're not competitive for salary. I mean, I can go into gory detail, but I won't. We have the highest turnover rate on transfers by far. So essentially, when someone comes in here and they work for a short period, 2, 3, 4 years in the agency, and then they leave, we don't just plug somebody in. You know, we have to bring somebody in. We have to take the cost of replacing whoever leaves. We have to get them trained. We have to hope we didn't make a mistake because we don't know what we have. The person we left, we know what we had. But the new person, you never know. You do your best. Sometimes it works. And almost every meeting I go to with you guys is peppered with the thing is we don't have enough staff to do this, and we don't have enough staff to do that, and we don't have enough staff to find out that we don't have enough staff. That's what we just told. And that's the truth. So we have the fewest amount of employees per population. We have, within driving distance, our competition is paying a lot more money for the exact same jobs, the exact same amount of seniority. And some of them can do it. I understand there's a difference. But that gap is huge. And you know, if you're up in Tuolumne County and you got that huge gap, doesn't mean as much because nobody's driving every day down to Santa Clara. But if you're here, they are. So you have to decide. And I think you are way overdue for a comprehensive staff analysis to come up with a plan to say, how do we overcome this? And that has to be, there's only 2 or 3 possibilities. One is to make sure you get the right key people and then get enough helpers. The other one is say we can't ever afford the key people, so we'll get mid-level management. But you've got to come up with a plan, because if we don't come up with a plan, we're going to be the same place we are next year. The residents of this county are paying for that, for our inability to staff properly. And I know as a resident who's very interested in how the government functions, even I pay for it, because when I go, I don't want to have to call the CAO because we're short on people who do the analysis and so on and so forth. I think I would appreciate it if you consider that, putting that in place, a complete staff analysis of what we're going to do and what our policy is going to be, and thank you for the extra time.
Thank you. Anyone else? That I'll bring it back to the board. Any other comments or concerns? CEO Espinoza.
Just wanted to highlight that we've had many conversations concerning what was just mentioned, and one of the goals is to allocate funding for such an analysis this year, in particular classifications. We're a unique county where we border probably one of the richest counties in probably the world, really, and we're a rural county, and we have done a compensation analysis. And when we look at that, we benchmark ourselves from rural counties. But the unfortunate aspect of it is we're so close to the Bay Area, where it's a very rich county, and so that is very complex. Our main source of revenue is property tax, and we're about the second lowest in the state of California with regards to the property tax allocation from Prop 13. So it really is difficult for us in particular. We have probably one of the lowest sales tax bases as well. So we have a very, very low amount of revenue coming in. However, we are competing with very, very high salaries of our neighboring counties. So, as this year is going to be one of our goals is to address classifications, to look at that, and to put in some sort of a recommendation to your board. But there's a lot of moving pieces with that. I just want to make sure the board is aware of that.
Yeah, thank you. And I think we all recognize, just the problem that Mr. Richmond brought up, and it affects us in just even the simplest of tasks. I have a constituent that's concerned about getting a building permit through, and it affects our, without the retention, your processes and procedures are non-existent, and we recognize that, and we've recognized it for a couple of years, and that's the difference in that OPEB report. The auditor is recommend, paying the full ARC, and the last couple of years we chose not to, and taking that money to try to funnel it to, employee, needs and department staffing needs, and that's where I makes big decisions. Do we continue to try to move that 76% to 80%, or do we allow it stay where it's at? And that's what makes it real hard. But I think the board recognizes that we need to improve retention. We need to provide opportunities for advancement in our county to retain staff where they could live and work here. So, good points. That's what makes budgeting fun. Okay, Melinda.
Can I add one more item to that too as well, Mr. Chair? So, the staff has been working diligently on some of the projects and to obtain some one-time money. So we've really worked hard around the clock in some cases. As I mentioned earlier, we have a legal item, and that's probably another realistically about another $8-9 million probably of one-time money. That's the problem. We've been looking at our reserves, and it's more one-time. So it's very difficult to look at that and then put that into salaries, and for that money to go away in 4 years or 5 years, and then we're going to be in a spiral where we're going to have to lay people off. So we have to be very conscientious of that. So.
Absolutely, yes. Okay. Yeah. Does that conclude item 4? We're ready to move on to item 5?
Yeah.
Okay. Thank you.
So in looking at the preparing the recommended budget for fiscal year 18-19, we're at the very, very early stages that most of the departments have just turned in their requests. And so just a quick overview of where we are currently. The budgets were due to the CAO's office at the end of March, and we received about 85% of those departments' budgets. And so we sent out a notice last week saying that the budgets that were not received by the end of last week would be rolled over with the fiscal year 17-18 services and supplies amount, because we've already updated all the payroll information. So we have gotten more. We're not quite at 100%, but we're pretty close. The personnel changes or the new requests that we currently have are approximately $1.6 million. 1.4 of that is in the general fund, and about 220,000 came from behavioral health. Fixed assets right now are about $1.5 million, exclusive of the capital improvement budget. We have about $460,000 worth of items in the general fund, fixed asset type things. We have $1 million that were asked for in the IT department, $25,000 in human services, $30,000 in public health, $35,000 in mental health. Most of those are vehicles. And then we've been analyzing the fund balance, the reserves, and the contingencies. In the general fund, we'll be using the information that was provided to you in the 16-17 CAFR, plus or minus any estimated uses that we're going to need for 17-18. Our initial estimate is that we will not need to use reserves that are budgeted. However, it doesn't appear that we're necessarily going to be putting money back into reserves. All other funds, other than the general fund, we expect that they balance their budget based upon revenues. Their expenditures equal their revenues, and any fund balance that's needed. And contingencies will be utilized again this year as needed per fund. We're at our special board meeting in May. We should have a budget that's pretty close to being balanced to present to you. Our goal is to have a balanced budget at that point. And then we're excited to present to you a presentation by OpenGov. I believe they will be here at that special board meeting. And instead of just showing you numbers, $1, $2, $1 million, OpenGov is more of a visual presentation. They have a lot of graphs and pie charts, and so to somebody who doesn't really enjoy looking at all the numbers, Joe Paul and I look at all the numbers all day long, but to most people, it's easier to look at a chart or a pie chart, a graph, or something like that. So we're excited to show the presentation of our budget at that point in the OpenGov module, and they should be here that day to do the presentation and show you where we are in our budget. Any questions? Any comments?
Any questions?
Mr. Chairman,
Supervisor Rivas?
So, Melinda, can you go up to the top part there?
To which part?
The very beginning there, the new requests.
Personnel?
Yeah. And so would we be able to have a breakdown of those specific requests in the future?
There's been a combination of new employee requests, not really so much of new staffing requests, but a lot of addressing salary issues
Okay.
There's been a lot of movement within classification.
And the reason I ask is because I have last night I attended a Juvenile Justice Commission meeting, and the commission, some of the members raised some important points related to the provision of mental health services. And specifically, it was related to this perception of this gap in mental health, the services from our county to the youth that need these services, that have gone to, our juvenile hall. And so certainly addressing this situation, if it's related to budget issues, if it's related to priorities, that I don't know. And so that's why this may or may not be a good forum for that discussion, but it may be. And so maybe we can agendize it for a regular meeting, or we could have, a meeting offhand with our probation chief and staff, so that way we can properly address it at the commission level.
Okay.
So.
And I have had requests from both probation and behavioral health to look at staffing, classifications. So that's part of that $1.6 million. I've met with almost every single department to try to get an idea ahead of time instead of just waiting for budgets to be turned in, to see what they're looking at staffing-wise and services and supplies too. So I think we have a pretty good idea of what people have been looking at and asking for in their particular departments.
Fantastic. Thank you, Melinda.
CEO Espinoza, you have...
Yeah, I was just going to kind of piggyback on that. So with regards to that, well, as always, we go through this process. We receive the information from the departments, and then we actually go back and meet with them. But Melinda's been proactive, taking a proactive approach this year. And, we'll obviously discuss with the department heads their needs. And if there's anything that really stands out, we'll definitely make sure you're aware of it. And if we have to, we'll bring some of those items back to your board. Just wanted to make sure this is so far what we received from a personnel perspective, as well as even from a services and supply perspective for this year's budget. Regarding next week, I just wanted to highlight as well, that was part of the transparency piece that I discussed with your board probably 2 years ago concerning budgeting and having the public aware of our fiscal standing and where we're at. So OpenGov will be a really good tool for the public to use and to see. They can actually go through and look at different budgets and funds and actually play with the numbers and play with graphs and look at things with our actual budget. So it'll be tied into our ERP system that will be importing this information into it regularly. So it'll be a really good tool. Hopefully the public can come and actually view it and look how to learn how to use that tool, as well as your board as well. We also purchased that for archival purposes from our old system as well, so we have some older data in there.